Good morning. Welcome to our today's class. This is accountancy. Now, last week I had sent you some notes on this topic, that is forecasting. Now, this is forecasting using percentage of sales method. Now, there are those assumptions which are normally followed, or the assumptions underlying the percentage of sales method. They are there in the notes, so you can just review them in your student portal. Today, let's look at a question. So we have this illustration. Now the question says, the following is the balance sheet of KD Limited as at 31st December 2017. So we have net fixed assets, we have current assets, we have financed by ordinary share capital, we have retained earnings, we have 10% debentures, trade creditors, we have accrued expenses. Now all this is giving us 400 and 400. We have additional information. Number one, the sales for the year 2017 amounted to shillings 500,000. The sales will increase by 15% during the year 2018 and 10% during the year 2019. Number two, the after-tax return on sales is 12%, which shall be maintained in future. Number three, the company's dividend payout ratio is 80%. This will be maintained during forecasting period. Number four, any additional financing from external sources will be effected through the issue of commercial paper by the company. Required, number one, determine the amount of external finance for 2 years up to 31st December 2019. And number two, prepare a pro forma balance sheet as at 31st December 2019. So this is the question we want to look at using the percentage of sales method. Let's do this question. So there are those steps which needs to be followed in forecasting using percentage of sales method. The first thing, so we have here, we can have them as in form of workings. So number one, we need to identify those items which are related to sales. We need to identify those items which are related to sales. So the first one in this question is net fixed assets. Then we have current assets. Next we have trade creditors. Next we have accrued expenses. So these are the items which are directly related to sales. So step number two, we need now to calculate the percentage of these items in relation to sales. So calculate the relationship of the various items. So the step number two, we need to calculate the relationship of various items, the relationship of the various items in the balance sheet to sales. So these various items are those items which are directly related to sales. So let's start with the net fixed assets. So net fixed assets. So how much was the figure? From the question, so we have the net fixed assets is 300. So we have here 300. Now this is 300,000. Now sales for the year 2017. Sales for the year 2017 amounted to shillings 500,000. So we have here 500,000 multiplied by 100, like that. Now this will give you, I hope it's 60, so this is 300 divided by 500 times 100%, that gives you 60%. So we have here 60%. Next, we have current assets. Now current assets is 100, so we have over 500 times 100. So we have 100 over 500 times 100, that is 20%. Next we have trade creditors. So we have the trade creditors. Now trade creditors in the balance sheet was, we have trade creditors was 50. So we have here 50 over 500 times 100, that gives you 10%. And finally we have accrued expenses. Accrued expenses is 30. So we have here 30 over 500 times 100, that gives you 6%. It gives you 6%. So we have 30 over 500 times 100, so that gives us 6%. So this is the step number 2. Now step number 3, we need now to get the increase in sales. Increase in sales. Increase in sales. So we go to number 1, additional formation number 1. We are told that the sales for the year 2017 amounted to shillings 500,000. The sales will increase by 15% during year 2018. So this is a question on forecasting, which is for 2 years. This is a forecasting for 2 years. Now we have sales 2018, sales 2018. So sales for 2018 will be, we are told that they are going to increase by 15%. So it means that it will be 115. Where is this 115 coming from? You take 100% plus the increase. So multiply by the 500,000. You multiply by the 500,000. So this is 115 times 500,000. So that gives you, we have 1.15 times 500,000. So that gives you 575,000. This means that sales for the year 2018 will be shillings 575,000. Now we calculate sales for 2019. Sales for 2019. Sales for 2019. So we have we are told that for 2019 they are going to increase by 10%. So it is 10% from this point. 10% after the 2018. Don't use this one here. This is for the year 2017. Don't use this one. You use the 2018 one. So we have here 110% times 575. 575,000. So this gives us 632,000. It gives us 632,000. So it means that at the end of 2019, the total sales for this company, the KD Limited, will be 632,000. Remember, in our working number 3, we want to calculate increase in sales. This is the total sales. So increase in sales. Increase in sales will be equals to, you take this one now, so you can have it as sales 2019. You can just have it as sales 2019 minus sales 2017. Sales 2017, like that. Sales 2019 minus sales 2017. Sales 2019, 632,000 minus sales 2017, 500,000. So this gives us, we have shillings 132,000. So the increase in sales for these 2 years is shillings 132,000. 132,000. This is working number 3. Now working number 4, we now need to compute the amount of external finance required. So working number 4, we need to compute the amount of external financing required. We need to compute the amount of external financing required. So this is working number 4. So we have the amount of external financing required. Now we have increase. So we have an increase in net fixed assets. Increase in net fixed assets. So one of the assumption of this method is that this relationship will be maintained throughout the forecasting period. So our increase in fixed assets will be, you take the 60% times the increase, which is 132. The increase is 132. So we have here 132,000. So we have 60% times 132,000. That gives us 79,200. Next we have increase in current assets. So the current assets, we had a relationship of 20% of sales. So this is 20% of 132. Now we have 20% times 132,000. So that gives us 26,400. So add the 2. This is 79,200. So this gives us 105,600. So this is the total assets required. This is the total assets required. Now what does this mean? What does this mean? That is 20% times 132,000 plus 76,200. Sasa, this means that let's come up with interpretation. So we have here interpretation. So interpretation for this means is this one. For this company to achieve sales amounting to shillings 132,000, for the company to achieve an increase in sales amounting to shillings 132,000, it needs to acquire additional assets amounting to 105,600. I repeat that. For the company to achieve an increase in sales amounting to shillings 132,000, this company needs to acquire additional fixed assets amounting to shillings 105,600. Remember, one of the assumptions is that the company is operating at full capacity. The company is operating at full capacity, hence the increase in sales is not as a result of increase in inflation, but it is increase in production. So if it is increase in production, it necessitates the acquisition of additional fixed assets. Now in this case, the additional fixed assets which are going to be required will be amounting to shillings 105,600. Now the next thing which we need to ask ourselves is that where will this money come from? Where will this money come from? That is the question we need to answer. After that, interpretation. Now, interpretation, I've already explained it there. So we have now, so we have here amount okay, this one we can have it as amount of this one we can have it as increase in, we can have it as increase in total assets. We can have it as increase in total assets. We can have it as increase in total assets. Then this is amount of external financing. We can have it as amount of external financing. So we have here, figures are in shillings. Yeah, figures are in shillings there. So we have amount, total assets required. So we have here assets required. Assets required is 105,600. 105,600. Now the financing will come from internal sources. If internal sources will not be sufficient, we are going to go to the external sources. So external sources, you will have to be told by the examiner. Examiner will tell you where that external sources will be coming from. It might come from short-term sources, or it might come from long-term sources. In this case, it is coming from short-term sources, that is a commercial paper, but sometimes it may be, the company may be issuing some additional debentures, or maybe the company may go for long-term loan. So an examiner has to tell you where the external financing will be obtained. Now we go to internal sources. Internal sources, we have the spontaneous sources of finance. Now the spontaneous sources of finance are those sources of finance which normally comes up as a result of activity of the organization. We have one, trade creditors, and we have the other one as accrued expenses. So we say less spontaneous sources So we have spontaneous sources. So we have the first one as increase in trade creditors. Increase in trade creditors. So we had calculated the relationship between the trade creditors and the sales. So this one was 10%. So you take 10% of 132,000. Take 10% of 132,000. That gives you 13,200. Then we have increase in accrued expenses. Increase in accrued expenses. This is 6% times 132,000. 6% times 132,000. So that is 7,000. So this is 7,920. Add 13,200. So we have it as 21,120. Now from spontaneous sources, we've obtained shillings, 21,120. We are moving on very well. So next, we have retained earnings. So we have it as retained earnings, or simply retained profits. So retained profits, if a company is not, if the company has not adopted 100% payout ratio, that's when we are going to get something from retained earnings. So we start with 2018. 2018. Now what are we told in the question? What are we told in the question? Can you look at number 2 there? Look at number 2. Number 2, addition formation number 2, that is In addition, for measure number 2, we are told that the after-tax return on sales is 12%. Now, after-tax return is the same as net profit margin. So we are told that the after-tax return on sales is 12%, which shall be maintained in future. So the company is going to maintain. So we have their 2018. So we have after-tax return is 12%. So you get 12% of what? For the year 2018, we had calculated the sales. We had calculated the sales in our workings number. It was working number what? It was working number 3. Can you check at your workings number 3 there, where we had calculated the increase in sales? So for the year 2018, the sales for the year 2018 were shillings 575,000. 575,000. So calculate that profit. So this is 0.12 times 575,000. Now that gives us 69,000. So the net profit for the year 2018 was shillings 69,000. Now we go to number 3. Look at number 3 there. In number 3, we are told that the company's dividend payout ratio is 80%. So it means that this company has not adopted 100% payout ratio, but see, it has adopted 80%. So we say here, less what? Dividends. Less dividends. So dividends are paid at 80%. So it is 80% of this one. So we have 80% of 69,000. 80% of 69,000. So we have times 0.8. So that gives us 55,200. 59,200 subtract. So we have 69 minus answer. That is 13,800. 13,800. So in year 2018, from retained earnings, we've obtained 13,800. I think we are now moving on well. So let's do for 2019. So we have here 2019. We are just going to move in these steps. So the first one is that you need to calculate after-tax return. After-tax return. So this is 12% times. Now the sales for the year 2019 were shillings 632,000. 632,000. So we have 0.12 times 632,000. This is 75,840. 75,840. Then you say less the dividends. Less the dividends. Now again, we are told that the company is going to maintain this payout ratio, that is 80%. So we have 80% of this one here. 80% of 75,840. So you have times 80%. Now that gives us 60,672. Subtract 75,840. Subtract that one. So we have 15,168. So for the year 2019, we got 15,168 from retained earnings, or if you like, retained profits. Now let's get the deficit. Let's calculate the deficit. So this is 15,168 plus 13,800 plus we have 21,120. So that gives us 50. Now we subtract from 105,600. So that gives us 55. So that gives us 55. We have 55,512. We have there 55,512. There is a mistake here. This was 12% 500. The increase in sales, I think we have 575,000 times 1.1. So it should be 500. It was supposed to be 500 here. It was supposed to be 500. So let's correct that. That's why I normally say that it's good to be confirming these figures. So we have by 60%. This is 0.6 times 132,500. So this is 79,500. This is 0.2 times 132,500. This is 26,500. Add the 2, 79,500. So this is 106. So we have there as 106. So we have here 106,000. So we have to correct this one also. So we have, this will give us 13 to 50, that is 10%. Now this is 0.06 times 132,500. That gives us 7950. 7950. So we add 13 to 50. So that is 21,200. So this is 5 there. Now 12% times 632,500. This is 75,900. So this is 75,900. You get 80% times 80% of that. So this is 720. Now we have 75,900 minus answer. That is 15,180. Like that. So let's get the deficit. We have 15,180 plus 13,800 plus 21,200. So that gives us 50,180. So this 50,180, this is what the examiner is telling us, that it will come from commercial paper. So we have here commercial paper. Commercial paper is normally a short-term source of finance. Is normally a short-term source of finance. So commercial paper of shillings what? 50,180. So the total assets required is 106,000. So it means that interpretation will now be for this company to achieve an increase in sales of shillings 132,500, it needs to acquire assets amounting to shillings 106,000. So this is Roman 1. This is Roman 1, what is required. Roman 1 there. Now next, let's come up with the balance sheet, the pro forma balance sheet. I hope you don't have a question. So we have Roman 2. So this is KD Limited. This is a pro forma balance sheet. Or you can just have it as a pro forma statement or forecasted statement of financial position. You can also have it in that for you can have it in that term. So we have here as at 31st December, as at 31st December 2019. So we have here shillings and shillings. Now there are two ways in which you can come up with this balance sheet. One is whereby you can have your 2017 figures, then you add what? You add the increase. You take your 2017 figures, you add the increase, or alternatively, you can just use the relationship of the various items which are related to sales as a percentage of sales. So the first one is net assets, net fixed assets. This is net fixed assets. So we have here net fixed assets. So this one was 60% times 300. 60% times 300. No. We have it as 632,500. 632,500 are the forecasted sales for the year 2019. So we have 0.6 times 632,500. So that is 37,900. Next we have current assets. This was 20%. It was 20%. So we have 20% times 632,500. 632,500. So that is 126,500. So we add 379,500. So this is 506,000. So this is known as total assets. Here you can have it as non-current assets. Then we say financed by. We have ordinary share capital. Now, one of the assumptions says that the company will not issue any additional preference shares, debentures, or ordinary shares. So this one will remain as it is. It will remain as it is. In this case, it was 100. So we have it as 100,000. Then we have retained earnings. So the retained earnings for the year 2017 was 70,000. So you are going to add what was retained in the year 2018 and what was retained in the year 2019. So for the year 2018, we retained 13,800. So we have that 13,800 plus what was retained in the year 2019, which is 15,180. So add all this. Now we have 70,000 plus 13,800 plus 15,180. So this is 98,980. This is 98,980. Next we have 10%, so we can have it as non-current. So this is non-current liabilities. Non-current liabilities. So we have 10% debentures. 10% debentures. This is 150,000. So that one will be the same. Next we have current liabilities. So current liabilities, we have two items here. That is trade creditors. Now trade creditors, we had calculated the relationship, which was 10%. So we have 10% of 632,500. So that is 63,250. 63,250. And the other one is accrued expenses. So accrued expenses is 6% times 632,500. So we have 6% 5% times 632,500. This is 37,950. Then don't forget the commercial paper. Don't forget the commercial paper. Commercial paper is one of the current liabilities. So commercial paper, we got the figures 50. Is it 5180? Can you check? Was it 5180? So commercial paper was 55. It was 55,820. 55,820. 55,820. Now let's add. So we have plus 63,200 plus 55,820. So this gives us 156,970. So we are adding all that. So we have plus 150,000 plus 150,000. Then we have plus 9,880. We have plus 100,000. This is 63,250. This is 37,950. This is 55,820. This is 379,500, 126,500. So we have 100, we have 98. This is 98,980. This is 63,250. Let's review our calculation. So this is 63,250 plus 37,950 plus 55,820. So that is 157,020. So this is 157,020. 157,020, like that. So we add 150,000. You add 98,980 plus 100. Yes. So we have here 506,000. So this is total as total equity and liabilities. Total equity and liabilities, like that. So that is what we are supposed to do in percentage of sales method. This is what we are supposed to do in percentage of sales method. So you just need to know those steps. You just need to know those steps which you are required to move. Let's meet in our next class. Thank you.